Welcome back, and we're joined by Rakshit Ranjan, who's from Marcellus Investment Managers, joining us live at this point of time. Rakshit, great having you. Let me first start off by understanding how's the tilt of the portfolio changing, if at all there is any churn. What is it that you're buying afresh post this earnings season?
Yeah, sure. Good afternoon. Thanks
Good
for
afternoon.
having me here. So, the tilt of the portfolio for us, it's tilting more towards internet companies which are using AI-based product value adds, tilting towards healthcare, hospitals, diagnostics, and even export pharma running on CDMO tailwinds. So those are two sectors I would say we've increased exposure to more recently.
So that's the tilt in favor of some sectors. Rakshit, hi, this is Nehi also joining in. Good afternoon. Talk to us about some sectors that you are adopting a more wait and watch approach towards, or somewhere where you are very cautious at this point.
Well, wait and watch, I would say there are a few names in capital goods. Valuations had run up a lot, but the tailwind from a macro perspective remains over the next 3 to 5 years. And the West Asia war has put a pause on some of those orders or put a drag on the margins for the time being. So, hoping to see some opportunities there in the next couple of quarters. This is particularly manufacturing exports in that sector, not so much domestic demand. So that's one. Another wait and watch is, I would say, even some of the private banks. We've been underweight for a long time and benefited from that so far. Valuations are becoming incrementally more and more attractive. Having said that, it's also quite interesting to see how the sort of pristine quality of the book and net interest margins progress in that sector. So those are some of the areas where I would say we are adopting a wait and watch over the next couple of quarters.
Rakshit, again, if I were to go back to that play on AI and the like, how are you looking at power and power ancillaries with that lens? Does the story change materially for them, and do valuations support buying into some of these counters?
So we've got one holdco of a power T&D play in our portfolio, which is there more because the asset itself is quite richly valued, but the holdco is on a discounted valuation. So it's a valuation related call on the holdco. And hence we are exposed to T&D particularly on the power side, where demand exists for the next 5 to 7 years. Order books are very long dated, as in the orders that you see today. There's a good predictability of revenues basis that for a few years, and capacities are yet to come up from all sorts of players who've started the capex. So we're yet to see a sort of competitive intensity of any sorts or pricing pressures of any sorts. So that's the T&D space of power where I would say we are more excited about. Rest of the power space don't have any exposure.
Rakshit, how about IT? How are you looking at IT right now? We're hearing a lot of mixed opinions when it comes to IT. Some people believe that the worst is behind us in terms of AI, and because of the kind of cut IT has seen, there's only one way up, while others are still concerned about the adoption of AI and the impact it could have. Where do you lie on that spectrum?
We are in the latter camp.
Okay.
As in we're still concerned. Maybe it's just us. Maybe we don't understand how it will evolve. But at the moment, we see a lot of uncertainty in terms of how the deflation of pricing and the substitution effects will play out for IT services. It's quite interesting to see how in the last 5 6 months the sort of emergence of internet players which are beneficiaries of AI, of the same disruption that IT services are at a disadvantage of, have started to come up, where initially in internet, I mean, this links to our increasing internet exposure as well. 6 months ago, there was a concern that will the LLMs sort of backward integrate everywhere, and they'll disrupt internet, as just like IT services is undergoing a slightly different type of disruption. I think so. We are trying to play the AI theme from the internet piece, where products are coming out by good quality management teams who understand this space, and those products are coming out in a way where AI is helping solve problems at scale which previously couldn't be solved without AI, and new use cases are coming out as a result. So that's where we are exposed. But on IT services, we've got zero exposure, and we think the uncertainty might prevail for a few more months, if not longer, before we can make up our minds.
Interesting. Okay. Rakshit, I wonder how you're looking at new age tech, and if that at all is starting to, or just your view, just give us a sense of that first off.
You mean new edge technology oriented players?
New age technology companies, the Eternals, the Swiggys, the Paytms. I wonder how you're looking at some of those names, and how should one rationalize those names?
Yeah, in fact, that's what I classified as internet. So we do have exposure, and we're increasing exposure. So I think the framework that we have in mind is, at the one level, wherever there is feet on street involved in executing the value add to the customer, and internet is the platform for that. We don't see backward integration of LLMs down to a level where they'll disintermediate an Eternal, for instance, the example that you took. So to the extent that competitive dynamics is not a concern, capital cycles is not a concern, we are comfortable. We are very actually excited about these spaces. There are lots of polarizations in the classified space. So some classifieds are getting totally disrupted because the discovery is happening on an LLM itself rather than on the platform. And so, for instance, education as a classified. But having said that, there are other types of classifieds. Could be used car classifieds, used product classifieds, or even it could be jobs classifieds, where previously a large scale high volume problem was difficult to solve with a lot of human intervention, and the new age technology is helping provide solutions to that. So we're increasing exposure in that as well.
Okay. And Rakshit, I just wanted to get your sense on all the new paper that we're seeing coming into the market. We're once again in that phase where we're seeing an extreme IPO rush. Are you looking at the primary market at all? Anything that looks interesting?
Only after companies get listed and a couple of quarters have gone by, proof of the pudding around governance, around what was there in the account, starts to emerge. We look at these types of listings. But yeah, I think in general, given how much of entrepreneurial activity the country has gone through in the last 5-6 years, secondly, given how much I would say new ways of executing business and generate cash have emerged post COVID, post all the wars, and hence the way government spending has evolved. I mean, lots of companies which 5-7 years ago never used to make returns on capital employed above cost of capital have started to do so. So that's the supply side into this listing piece, and at the same time, I think the way financialization of savings is occurring, there's a demand side to this as well. So at many levels, it makes sense to see more and more number of companies get listed, widening of the market with good quality businesses coming up, and there will be demand. But not all such IPOs are good. I mean, history has lots of skeletons coming out from the cupboard, etc. And hence, we try to take a more cautious view. Only and only if we've got a long history at the time of IPO available for us to understand. we go and take exposures. Otherwise, we let conviction build on us gradually before we take exposures in new listings.
And Rakshit, you've obviously been tracking consumption for the longest time ever, but give us the sense, how are you seeing the cycle, and what pockets should you bet on, rural, urban, and what within consumption, even if I were to split consumption up?
Yeah, so certainly rural is doing much better than urban, and it's also interesting that initially there were concerns around rural's recovery could be short-lived because of the El Nino and the weak rainfall effect, etc. On that side, sowing, the agricultural produce, etc., is not likely to be as bad as what was feared to be initially. Rainfall is better. So I think rural is certainly something which is, there are pockets of undervaluation or low expectations, positive surprise possibilities, which we are also increasing exposure to in our portfolio, and investors should do that. Urban, whilst it is holding up, I think market share gains and capital allocation is the way to grow earnings at north of, let's say, 15-17%. Otherwise, most categories of consumption, particularly FMCG, have approached a level where, I mean, mid-single digit volume growth is a very high one, which is not good enough in the long run for earnings growth rates to drive share prices above cost of capital in terms of returns. So it's a saturated industry, particularly the small ticket one. But the entire consumption piece is going through a massive price increases led revenue growth acceleration in the sort of short term. So after the crude spiked with the West Asia war and crude oil going to whatever 100 plus, price hikes were taken across FMCG, home building materials, and a variety of other consumption related industries. And that is leading to value versus volume gap widening to levels that we had not seen in the last 4-5 years. When you combine that with the possible operating leverage benefits that some of these companies could have, there is a short-term momentum. So, for instance, adhesives, paints, pipes, these are companies in the home building sector where value growth is 10-12% higher than volume, and that can certainly trickle down through operating leverage to earnings growth, getting a sort of acceleration in the near term at least. So those can be positive catalysts. I don't think they are very well baked into numbers in some cases, particularly for high quality players. And valuations have cooled off in the last couple of years in all of these areas. Share prices haven't moved. There's time correction that has happened. So valuation multiples are much more comfortable. So only in such pockets where you can see earnings growth through operating leverage, price hikes, and a very high quality capital allocation led, let's say, new category expansion that some companies are doing. If you've got earnings growth 20% or higher, we are taking exposures there, particularly where valuations are comfortable. But yeah, if you ask me for a 3 or 5 year view, FMCG is something which I would like to avoid unless the business is allocating capital to add new categories and hence grow far faster than the industry itself.
View on consumption and FMCG, and while you were talking about volume and value, Rakshit, how are you looking at auto, also part of the bigger consumption basket? We've heard one major player already come out with a price hike announcement, and come December or early next year, the price hike series will once again be at play. How would you then look at volume versus value when it comes to autos? And within autos, is there any basket that you're liking at this moment particularly?
Yeah, no, autos pricing power is a little lower than the home building material, paints, pipes, adhesives examples that I gave you. So in autos, you won't see that bigger delta, and at best they'll protect margins rather than see any expansion in margins because of the price hikes. We've got two types of exposure to auto in our portfolio. One is a two-wheeler premium player who is benefiting from a massive narrowing of the gap between premium two-wheelers and the sort of below 250cc motorcycles. And that narrowing of the gap is leading to recruitment from sort of mass market into premium segment, accelerating in a way which could actually sustain beyond just the short-term GST benefit of money in the pocket and things becoming a little cheaper like for like. So there could be actually premiumization gains here for the category as a whole. Competitive intensity we see being pretty low in that area, and hence that's one space I would say in the OEMs we've got exposure to. And the second one is a tractor business, which is again a beneficiary of kind of a turnaround in business prospects, capital allocation, acceleration towards export orientation, and hence when you look at the valuation of that firm as well, there are some opportunities. So these are exceptions. Overall on auto, beyond these couple of names, we've either got a wait and watch or a sell recommendation internally.
Rakshit, thank you so much for joining us, giving us that perspective.